Record a little video today to explain this 2021 Vanguard index chart poster that will have attached in Compass as a PDF. So this is a index chart produced by a company called Vanguard, and it actually tracks market returns over the last 30 years between the 1st of July 1991 to the 30th of June 2021. So I'm going to scroll down a little bit, and you can see here that this chart gives you the years along the x-axis or the horizontal axis from 1991 all the way across to 2021, which is this year. On the y-axis, you'll see amounts of money. So $10,000, $50,000, $100,000, and $200,000. And you can see here the gaps are not even. That's because it's on a logarithmic scale. It's quite a technical term. Ignore that for now, but basically it means that the gap between these two numbers is actually smaller than the gap between these two numbers. It gets a little bit compressed at the top of the chart. So what this chart is going to explain to you, or try to show you, is how important patience is in investing, and it also will compare different types of investments across this period of time. So let's get into it. So we're going to compare today some of these line graphs on the chart. Okay, so we're going to look specifically at US shares in the light blue, Australian shares in the orange, Australian listed property in the pink, which is things like buildings, houses, factories, warehouses, farms, anything that's a physical land or buildings. And we're also going to look at cash, which is in grey. So what this is showing is that if you had $10,000 just sitting in your bank account, what that would have returned you over a 30-year period using these different asset classes. So if you had $10,000 and you decided, you know what, I'm just going to stick it in the bank, in a bank account, and leave it as cash. Now there'll be some interest that it earns. And what this is showing is that if you'd done that over this 30-year period, the cash would have increased in value, at a reasonable rate, but not nearly as fast as other asset classes in this chart. And at the end of 30 years, you would have nearly $40,000. It would have returned you 4.6% per year. Okay. Next one we're going to look at is Australian listed property, which is, as I said, buildings, houses, factories, anything like that, anything physical. If you had $10,000 and bought some physical property, that would have tracked along the pink line like this, would have done very well right before the year 2007. Then it would have come right down and then tracked up again to the current year. Then it would have crashed a little bit due to COVID, and then finish up here. You would have had $118,000 essentially, returning you 8.6% a year. So you can see there's a huge difference between buying property over this time than it would have been in just keeping it in cash. Fantastic. Let's move on to Australian shares. So this is things that we've looked at this term, such as if you bought shares in the Commonwealth Bank or CSL or JB Hi-Fi or carsales.com.au or ResMed, or lots of Australian companies that you can buy on the share market. If you had $10,000 in 1991 and put it in the share market and didn't touch it for 30 years, didn't add anything else into it, that would have tracked along quite nicely up until up until 2007. Actually, just slightly outperformed here by Australian property, which we just looked at. Then it's come down sharply, and then it's bounced back a little bit. You can see here as well, it's come down again in 2020, and then you would have ended up with 160,500. So it's outperformed listed property, and it's 160, pretty decent return over this time. This is just if you had $10,000, stuck it in the share market. Finally, the light blue line is US shares, things that we've talked about, and a lot of you have invested in your share market challenge, things like Amazon.com, Apple, Google, Unity Software, all sorts of other things. John Deere, some of you have invested in as well, the US share market. So that would have done very well right up until the year 2000. Then there was a bit of a crash, which we'll talk about shortly. Let's come down here. And between this period and this period, it's actually gone relatively sideways, which is it's almost a 10 or 12 year period. You've kind of gone backwards or sideways. Then from here onwards, it's been just a huge, what we call a bull run. It's just really driven up. And you can see here that US shares has been the best performing class of asset. And if you had just put that $10,000 into US shares in 91, left it there, today you'd have $217,000. Now you can see here as well that the graph gives you some significant events over this time period. For example, the Asian currency crisis in 97, the dot-com bubble burst in the year 2000. That was when a lot of really silly internet companies crashed. Obviously, the terrorist attack in 2001 as well, in which the World Trade Center came down. You can see here as well the global financial crisis, the GFC. You can see here as well, probably the most important one in recent times is COVID-19, which is started in 2020 and is still really running ahead. So this is a piece of, it's a chart that gives a lot of information, and I'm going to give you a worksheet asking you some questions about this. Probably the key thing I'd like to take away from this is, with all these ups and downs, all these huge events that have happened in 30 years, the share market, the property market, generally speaking, has gone up and to the right. If you're patient, keep your head, don't panic and sell, you would have done quite well over this period by just investing and staying invested. All right, thanks very much, and I will see you hopefully in class soon.